Apple and Microsoft each boast a valuation of multi-trillions of dollars, but which one of these two is the better large cap tech stock to buy today? I'm going to answer that question in this video by evaluating these two companies on revenue growth, operating profit margin, cash flow from operations, return on invested capital. And then I'm going to look at their valuations on a forward price to earnings basis and looking at my discounted cash flow models for Microsoft and Apple to determine which one of these two great companies is a better investment today for long-term buyers. Let's get started.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Looking at revenue over a trailing 12-month period and looking back a decade, two things stand out to me. Number one, Apple generates clearly a lot more revenue than Microsoft, over $130 billion more to be precise. But the second thing that stands out to me is also really important, and that is the growth rates. You can see Apple's growth rate has almost flatlined in the last 3 years, demonstrating close to zero growth in that time, whereas Microsoft is demonstrating excellent growth in that time, in fact, accelerating its growth and closing the gap to Apple in terms of total trailing 12-month revenue. And we're going to see one of the factors here a little bit later when I talk about return on invested capital, how maybe Apple could accelerate its investments to try and develop or accelerate its product launch schedule to generate more revenue with more innovations. One of the biggest knocks on Apple in recent years has been its lack of innovation. Its flagship product, the iPhone, has barely innovated in the last decade. We've seen mostly incremental improvements with a little bit better battery life, a little bit better screen, a little bit better camera, a little bit faster processing. And so not really any leaps and bounds. And the most latest development in artificial intelligence has received mixed results. And so maybe when I talk about the section on return on invested capital, there's an opportunity there for Apple. Meanwhile, Microsoft is one of the biggest winners here in the artificial intelligence category. Microsoft is a major investor in OpenAI, the creator of ChatGPT, and Microsoft is benefiting significantly from that relationship in many ways, most notably in its equity share of OpenAI and the increase in valuation of OpenAI. And then secondly, OpenAI has a relationship with Microsoft Cloud where the computing power, and it needs a lot of computing power, it buys it from Microsoft. And so that generates significant high margin revenue for Microsoft's business as well. The next thing I'm going to compare these two on is the operating profit margin. And you can see that big dislocation around 2016 when Microsoft's operating margins truly exploded higher from around 26% in 2017 all the way up to 45% in the most recent trailing 12-month period. This is one of the reasons, among many, that Microsoft CEO Satya Nadella has received tremendous credit for being one of the better CEOs in the markets today. Of course, not to be undone, I think Tim Cook has also been an excellent CEO at the head of Apple. But Apple's margins haven't increased by all that much in the last decade, growing from about 30% to 31.76%, despite it increasing one of the most profitable segments, the services segment, right? Apple's services segment generates gross profit margins over 70%, and that segment over the last decade has been growing much quicker than the rest of the business overall. And so what that tells me is its hardware segment is losing effectiveness in profitability. Its margins in the hardware segment are contracting, and the margins in the services segment are making up for the gap in margins in the hardware segment. We see a similar story with cash flow from operations to sales, except it's even more pronounced in favor of Microsoft. 48% cash flow from operations to sales, which is one of the better numbers you'll see among any company that I follow. Number at 48% is right at the tippy top of this range, probably in the top 5 or in the top 10 of all of the companies that I follow. Meanwhile, Apple's cash flow from operations to sales is falling from around 35% down to 27% in the most recent trailing 12-month period. Apple, remember, doesn't manufacture its own products. It outsources that to third-party companies like Taiwan Semiconductor and Foxconn. And so that relieves a lot of pressure in terms of cash flow. But also Apple does help its suppliers with billions of dollars in research and development costs, in other technology improvement costs that Apple is willing to pay its suppliers for, because Apple is so large in scale and so important. Its suppliers work with Apple more closely than they would in most other supplier-buyer relationships. So in the one metric that Apple clearly beats Microsoft, it's one of the more important metrics, and that's the return on invested capital. Apple's return on invested capital is double that of Microsoft at 56% compared to 28%. And what's also important with the return on invested capital is to compare it with the company's weighted average cost of capital. So Apple's return on invested capital is over 56%, and its weighted average cost of capital is 11%. So its ROIC to WACC ratio is about 5-1, which is an incredibly positive ratio, among the best you'll see of any company that I follow. Meanwhile, Microsoft, its return on invested capital was around 28%, and the weighted average cost of capital is 9.3%. So its ratio is about 3-1, which is still a really good ratio, but it trails behind Apple's incredibly strong ratio. So now that we looked at all of the critical financial metrics that we're going to compare, let's look at valuation. Apple is trading more expensively than Microsoft when measuring by the forward price to earnings ratio. Apple's forward PE is at 29.71 compared to Microsoft's forward PE at 27.3. I sometimes get asked why this forward PE is different than some of the forward PEs that you might be seeing. This is the forward 1-year price to earnings ratio. So it's looking at the current market price compared to the expected earnings per share over the next 4 quarters. You might be looking at a forward PE that's just looking at the next upcoming quarter earnings and annualizing that, or some other method that's a bit different than this one. If you're looking at the forward 1-year price to earnings, you're likely to find the same number that I'm getting here from Y charts. When I did my discounted cash flow valuation for Apple, I found its intrinsic value per share to be $161, where its market price is now at $244. So it looks overvalued according to my discounted cash flow model. And when I did the same discounted cash flow model for Microsoft, I found its intrinsic value at $447 compared to the current market price of $411. So in both valuation metrics, whether it's the forward PE or DCF, Apple looks more expensive than Microsoft, and especially in the DCF. And Apple only beat Microsoft on one ratio, and that was the return on invested capital, where, remember I said that could be reduced now because Apple's lack of innovation may force Apple to spend more on research and development to try and speed the pace of innovation, because they're falling behind on innovation and they're opening the door for competitors to come in. And you're already seeing that in China, Apple's losing significant market share. So I suspect that this gap will close on return on invested capital between Apple and Microsoft. And then Microsoft was beating Apple across the board on the 3 other categories that I looked at. So if I was to compare these two, which I did, and I had to choose one of them to buy, I would buy Microsoft instead of Apple at current prices. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.